that is definitely where we found our sweet spot instead of doing it ourselves to grow together. And it is possible, especially if you want to be like us. We wanted to preserve our cash flow, continue to scale and decrease our liability, and overall just keep reinvesting our profits. And that's what we've been able to do.
Because the management and transparency is what's very important. So once you submit a referral, you're going to have your own Home Advantage account, and it's going to tell you where everything sits. So if you have 10 referrals that you've sent into the network, it's going to give you all 10 referrals. It's going to tell you every milestone that client is sitting in, whether they're touring homes, whether they're in escrow. And you now can manage through the Home Advantage application as far as what your pipeline looks like for the referrals that you've sent. And so it's pretty sophisticated, and it's all click of a button, guys.
Hello, LabCoatAgents. Exciting times today. We've got Maricela Soberanes going to talk to us about investing, diversification. We're going to talk mobile home parks. We're going to talk multifamily. We're going to talk storage facilities. We got a lot to cover. I'm just excited to talk to you, Maricela, about all of these options because yeah, I'm a real estate guy. We run a large team in Washington, D.C. of about 20 agents, and we're always thinking about investment options, right? And we talk about multifamily and we talk about storage units. It's really tough to be an expert in all of the categories, and I'm so excited to talk to you. Maybe you can just simplify, water this stuff down for me, and I'm going to ask some questions, and I'm just here to learn. I'm certainly not the most educated in the room, but I hope to be the most informed by the time we're done. So let's go from there. So Maricela is the founder of UpLex. And what is UpLex? What do they do? And how the heck did you get into this space in this world?
Thank you, Jason. Thanks for having me. And hello to all the audience. Super excited to be here and to share what I know. I am definitely not the expert at all, and definitely a student of life. But the secret sauce, and if I was to share one thing and drop off, it will be to leverage on other people's resources and experiences. That's the key word. That's the secret sauce to collapse the time frame that will take you from where we are to where we are going to be or want to achieve. So definitely collaboration, leveraging on each other, finding the partnerships that are going to be propelling to your journey, to your industry. That is where every successful person that I know have used every technique that they've used and they've been successful at. So so what is UpLex? UpLex is a complex or a group of companies, and it's branded by UpLex because that's the beginning and the roots of it. We started with a residential portfolio in Austin, Texas. We were serving families as a small multifamily portfolio. Started with duplexes, houses, fourplexes, and slowly built up the portfolio that was managed by my husband and I. He's also a business partner. And we pretty much did it all. It was a mom and pop kind of shop. We did the maintenance, the ordering, the leasing, advertising, and everything. So and then we progressed to multifamily, including complexes, 120 plus units at a time. And then we diversified to do self-storage and mobile home parks. Again, everything, mobile home parks and self-storages are much smaller acquisitions, usually less than 3 million. And we are able to do that with in a joint venture fashion. So that meaning we bring one or two other partners to purchase the asset, and then we all collaborate to manage it. And ideally, we team up with somebody that has the time and the knowledge on those different aspects, the self-storage and mobile home parks. And now we learn the business. Now we can lead the acquisition for that type of asset. But when we first started, we were definitely learning from our partners. And for the multifamily, we pay for mentorship, we pay for coaching, one-on-one and group coaching that put us in a position that now we are able to lead those acquisitions and asset management for that kind of properties. So.
And what year? Refresh me. Your first year, 2006 was your very first acquisition in single family.
Correct. Yes.
Okay.
2000. Yeah, 2006 and Austin, Texas. And then we started transitioning to multifamily and other assets in 2020. We started also doing private lending money. We did note acquisitions, and yeah, we kind of diversified to mostly keep our cash flow. And when we talk about diversification, depending on the type of investor that you are or that you are inviting, we have the three iconic types. You want either cash flow, you want appreciation, or you want tax benefits. And ideally, you want the three of them. That's what we wanted. But one single asset is probably not going to provide those three things. Again, cash flow today, appreciation for later on, and or the tax benefits. So we combine those type of assets that mostly what we see in the self-storage and mobile home parks have a higher cash flow in today, less appreciation and less tax benefits, just because the cost segregations that we do are lower, capital expenditures are lower. Now, when you are talking about a syndication model with a larger acquisition, we have sometimes at the beginning when we take over the property, we have less cash flow, especially these days when the market interest rates are kind of all over the place, mostly going high. So the cash flow is not necessarily there, especially when we take over a property. But then the appreciation, depending on the market that we choose, we stay in the primary and secondary markets. So appreciation is something that we have seen in our portfolio. And then definitely the tax benefits for the syndications have been the strongest one.
Okay, so take me, I get it. And by the way, guys, if you have questions, throw them in the Q&A, throw them in the chat. We'll get to them. If you have some of these types of investments already, it'd be awesome for you guys to put that in there as well, so we know who's with us and what they're doing. So we'll try and field your questions in real time as best we can with that. So from 2006 to 2020, you were still playing in the single family home market. How many single family homes did you acquire or under your management? What did that look like for that period of 14 years?
Yeah, it was 35 doors altogether. Again, a combination of houses, duplex, fourplex, and an eightplex. A total of about $4.5 million portfolio.
Okay. And then, and this seems to be the natural progression for people, is you play with single families for a little bit, and then like, all right, the next phase is multifamily. So then we dabble in multifamily in 2020. And I think I heard somewhere that you got 2,500 doors right now. Is that accurate?
2,800.
28. Okay.
About 2,800.
28. So there was a massive growth moment between 2020 and to today for you. What was that moment? Why then? Like, walk me through that explosion point of the 14 years, and then you're like, boom, now we're going to be a part of 2,800 doors. That's big.
Yeah. So mostly it was coming into communities that were doing the things we wanted to do, paying mentorship that we were underwriting and looking at some deals, but we were not confident on pulling the trigger and going under contract for multi-million type of assets. So having that shadow pretty much looking after what we were doing, and every time we were on the road something, send it out to the coaches and they gave us the feedback. We felt much more comfortable not only putting our money, but now taking other people's money. And that was the second piece of the I would say the secret sauce for our excel or growth in such a short amount of time. So having the paid mentorship, having somebody that was overlooking or underwriting, and then taking on other people's money. So taking on other general partners that we found, that we team up, and then bring in capital from passive investors.
And that's the syndication piece.
That is the syndication model, yes.
And so that was that model is what led to the explosive growth, is having access to capital that wasn't completely dependent upon you and your husband.
Absolutely, yes.
Okay. And syndication is that, I mean, that's a term that's thrown around a lot. I hear it, I think I understand it, but at its simple form is there's a point person, right? You're that point person, and then you actively recruit investors, and I may be terming this wrong, so stop me. And investors come in, and in many ways they come in a passive form. But I want to talk about that first. Did I get that right? Is that the accurate?
Yeah.
Okay.
The simplest way to explain it is that you leverage on other resources. So you gather a group of investors that are capital partners, so capital investors, and those are the passive investors. And then you have the active group, which are the group that is going to be looking for those deals, underwriting them, getting them to the lender, securing the loan, signing on the loan, managing the day-to-day operations to implement the business plan. That's the group that is the general partner. Majority of that group is going to be passive investors, depending on what the rates look like, what amount of money we have to bring to as a down payment to the table. That's how many investors we will invite.
Okay, so passive, literally passive. Give us your money, we'll do the rest. Active, they're going to be limited partners where they may be involved in the management, they may be involved in the funding, they may be involved in the more day-to-day operations.
Correct. Yeah. And as a general partner, we and this is our policy and our model. As a general partner, we actually invest in limited partners. So our money is working along the money of the passive investors.
Got it. Okay, I understand. So you're invested in the projects as well. All right. So as you start building up the multifamily, you get into syndication, and then now, and here it comes. It's all of these things I mentioned. Multifamily, there it is. Oh, and here comes. Let's look at storage facilities. Right? Did storage facilities come after multifamily for you?
Yes. Yes, they did.
And then somewhere around the same time or shortly thereafter, here comes mobile home parks, right?
Correct. Once they just start opening the door to partnerships, there's so many, it could be distracting, but there's so many options that you can explore for sure.
So if you look at all three of the classes or four of the classes there, which one are you most excited about right now?
Right now, the ones that are cash flowing steady. And those are the properties that the self-storage and mobile home parks are very strong performers right now. And also we have amazing partners that we collaborate, and it's not a huge burden. We were doing more work with the single family portfolio than what we're doing now for those other assets. So it's definitely less hands-on, more cash flow, and less liability, because we share the liability with our partners. And it's just, we can collaborate rather than doing it all by ourselves.
And here's the golden question, answer it how you will. How do you get opportunities to these deals, like mobile home parks? I mean, opportunities are now coming to you, I assume.
They are, yes. Through the networking that we've been doing over the years, we are, people comes to us, wanted to partner. Some of them bring the asset, and some of them bring the capital, and we just glue both. We just are the connecting piece pretty much. And some of the deals also, because we have closed with some brokers, they feel confident that they can bring a property, so they present us with those opportunities as well. So sourcing the deal is something that we can definitely do.
And where are the investors? How are they reaching you guys? How are they learning about you? Is it I'll use the term accredited, not knowing fully if we want to get into that conversation or not. Is that part of it? Does everybody have to be an accredited investor to be with UpLex?
No, we actually, majority of the projects that we offer as an investment opportunity are open to both, to non-accredited and accredited. And if you want me to define those for your audience, I'll be happy to do so.
Please. Yeah, define them for me, not just the audience. I know the buzzwords. I'm not sure I know the exact definitions.
No worries. The way I learn is an adult learning style. Like I only learn if it's necessary, and I only learn it if it applies to me. So
good.
so there's two types of offerings that are the most common in the syndication model. And you can syndicate anything. If you have a dog, a horse that you like, you don't have enough money to buy it, you can syndicate it. You can bring passive investors. That's all it is. Like it's just the model. And there's two offerings that are regulated by the SEC, which is the regulating agency to protect the investors. 506B and 506C. And the difference between those two, 506B for me stands for body, Bob, friendly. So if you can think of your friends, your family, anybody that you already have established relationship as a friend or as a financial person that you already know, that's sophisticated, and that they have enough knowledge about the deal that you're presenting them with, or if you're going to be able to educate them and explain, hey, this is how you are going to make money. These are the projections that I'm offering. So you have to have a previously established relationship, like before you actually find the deal and present them with the opportunity to invest. For 506C is Charlie. Charlie goes on social media and is able to advertise everywhere because he's a chatty guy. So Charlie for Charlie, and that's a 506C, meaning that they can advertise if it's that offering to anyone pretty much. But when it comes to that person wanting to invest, that's when they have to prove that they are accredited. And what makes you an accredited investor is that you have a certain amount of income, which is $250,000 as a joint filing with a joint partner or significant other, or $200,000 a year of income, and that you have that for the past 2 years, and then you expect to continue to earn that in the next year or so. That's what makes you an accredited investor. And that accreditation letter you can get from your CPA, or we have third-party companies that can certify you. So that's all it is, 506C or 506B. And a 506B offering, we are welcome up to 35 sophisticated investors or non-accredited investors, and then unlimited amount of accredited investors. And for that offering, they don't have to do a letter and accreditation. They answer a questionnaire where they pretty much qualify themselves as having the requisites to be considered accredited investor.
Got it. Thank you for that explanation. How many deals right now do you have in the pipeline that you're actively seeking investors for?
I'm gonna do a little backup on that question. So when you find a deal, let's suppose that we found a deal today, we on the road, the deal makes sense, we make an offer, or offer gets accepted, then we move on to the due diligence, which is the inspections and everything. At the same time, we are activating the legal team. The legal team is putting together the offering for the investors and all the legal papers, the operating agreement. So at that point, when we draft all those documents, we are then able to present that deal to investors. So many times we're doing all the work and several deals at a time, but some of them don't come to be fully under contract and not fully ready to release. So we might be having 3 or 4 at the same time, and some of them don't mature to be an offering. So once that we said, okay, we passed all the inspections, we're happy, we're under contract, now we have the legal papers and all the foundation, then we do a webinar to invite the investors. And that is the first time that we present the deal to our investors. And at that point, then we can answer any questions and present the deal. That's when we open the subscription to the database. Right now, we don't have any of the at that stage. We have pretty much different fires started here and there, but none of them have come to, okay, this is something that I'm ready to present to the investors.
Got it. But on average, once a quarter, you have some, twice a year. I mean, obviously depends upon the deal flow, but.
Depends on the deal, depends on the market. But what I will say, from the time that we start underwriting a deal to the time that we close the deal, it could be anywhere between 3 to 6 months sometimes, depending again on the time of negotiation, lending, preparing all the documents for the loan. So we've closed 1 in 4 months, and that's pretty average.
Okay, gotcha. Why UpLex? I know a lot of folks are doing syndication, right? And I haven't done enough due diligence to understand the differences between. But if I were to be an investor, whether it be a B or a C investor with UpLex, what about UpLex makes you different?
Yeah, thank you for asking. So it is a 100% veteran-owned business and operated. My husband and I were veterans, and we are pretty much offering the transparency of a boutique investing. We are not a REIT that you dial a number and you will get to you next week, or maybe your email gets lost. You can text us pretty much, and we have investors in different parts of the world that you can text us and you expect a response rather quickly in less than 24 hours for sure. So we are common people, just like you. We came from, working at the hospital, working in the military, and building those systems. Now we have transitioned to do the small multifamily, and we are considered now, a progressing firm and investing firm, but we are still holding those values that if you have any questions, you can approach us. We pretty much are closing the gap between the companies that are not as accessible, that they might not have the time to do that one-on-one consultation on a daily or regular basis for our investors. You have the full transparency of a lot of our investors want to become general partners, because as general partner, you make more money. And we break down that possibility, and we are always looking for partners and within our circle of investors. So if you want to be an active GP, a general partner, that is one thing that we have helped 12 of our investors. And, it sounds like a small number, but to have a person that has never been in a multifamily now to buy in a $23 million acquisition, it's huge. And now they're making pretty much 10x or 7x in their money, depending on the projections. So as compared to the passive investor, we usually project between 1.8 to 2 times your money when you invest. So as a possibility of a general partner, we open those doors. We are actually always looking for that kind of investors that want to start passively and eventually switch to a general partnership.
Are most of the general partners that they get into that GP role through sourcing the deal? Is that a majority of the 12 you mentioned? Did they all source the deal, or how'd they get to become a GP?
Well, not necessarily. In fact, some might, but where we see most of the people that either have the time, so they want to do more hands-on, maybe attending the meetings, asset management, being more as a project manager, overseeing the first project. They might not have the experience, so we take the time to show them what KPIs we monitor, what key performance indicators we monitor in each syndication. Most of them, we require them to bring the investors if they have the possibility to activate a pool of passive investors. We teach them how to do pitching a deal, presenting a deal, answering the basic questions. And then if there's any more elaborated questions, we are there to back up their pitch pretty much. So ideally, they have a pool of potential investors that they can also bring in. The other piece of the puzzle that they filled in is net worth. So for example, if we are buying a $20 million deal or net worth, because the bank is going to ask to have the net worth equal of the amount of money that they're lending you. So if we're going to borrow $15 million and our net worth is missing a gap, so we have some business owners that are sitting pretty much in potential. Their business has net worth that can be used to help us sign on the loan, pretty much be a loan guarantor. So that's another gap that we often need, especially last year, we closed on a deal that price was $85 million. So it definitely requires more of those guarantors. So that's kind of the gap that many people feels. And, we always require for all the partners to bring the capital, because that's always an ongoing need.
What am I missing? And I know we're going to get into, we'll get into the forms of diversification and the reasons, whether it be appreciation, cash flow, tax reduction. Before we go deep on that, what you've done a very good job explaining it to me. And again, guys, if you have questions, throw them up. What else should someone listening know right
now? So what I think that a lot of people gets very enthusiastic when they see that the potential that they can become If we want to start in multifamily, especially if you're coming from the small multifamily or the small portfolios as a houses, that you see that your liability decreases when you're signing on loans that are guaranteed by a business. If you can think of a multifamily, you're buying a business and you have to implement strategies to perform, to show that the business is performing, and the value of the property is going to increase as the NOI increases. So the NOI is all the income minus the expenses. That's the leftovers is the NOI. That's how the bank is going to evaluate your property. So as compared to when you're buying a house, you're kind of depending on the evaluation of who else sells the house around your neighborhood or in the same zip code. So you are pretty much tied to what can they do to increase their value, and then your house kind of goes up with the value. It doesn't matter if you get brand new everything, the value is probably going to be tied to what's the market, right?
What recently sold, sure.
Yeah, so it's not the case. And when it comes to the multifamily, aside from that, I mean, you can push other income. Like we do Wi-Fi, we do water conservation studies that we change toilets immediately in the first week of acquisition. And that results in a large amount of savings, that those are mostly not cost effective, and even a small portfolio that we were managing $35. So those are the things that you can do as you scale, that you can implement those kind of other income or other tax expense reduction strategies. So those are the things that sometimes we oversee or we don't take into consideration. And the fact that you are, most people, I know when we were buying small multifamilies, we were putting the loans in our names initially, and then eventually we incorporated and put like LLCs in place. But even then, those LLCs were pass-through entities, meaning that the liability of anything that could happen to that LLC was going to fall back into us. So eventually we built a trust. The trust was protecting us to a certain degree. But when you're investing, even if you're investing passively, you're investing on an entity that it's the ownership. It's the owner of the building, but it has nothing to do with operations. We have a different LLC that carries on operations of collecting the rent, distributions, everything is separated. So if something was to happen in the property, and that person sue us, the person is going to sue the LLC that is collecting the rent. So it's the operating LLC. So, and our investors are investing in the ownership LLC. So there's this separation immediately. Plus the investors, because they're investing in an entity, like if you think of you invested in Coca-Cola, when something happens to Coca-Cola and Coca-Cola is sued, you're not going to be liable for answering to the lawsuit. That's right. Exactly the same protection that our investors passively have. Now, when you move to a general partner position, you do have more liability, but even then, those loans are non-recourse. So even if you sign on the loan, there's the limitation of liability that you have. So those are the things that, as compared to when we were buying everything on our name, it just, you can sleep better when you have that layer of protection.
There's a wall between results and liability here. So you mentioned 2x, 7x. I heard it. What's the life cycle? Like I know some of the game is played in a format that once depreciation hits a certain level, that's the right time to offload it to a friend doing the exact same thing who needs a new asset to depreciate. How long do you generally hold your assets?
That's a great question. So the projections usually we underwrite to hold it 3 to 5 years. Sometimes we, depending again on the market, depending on the business plan, we might say we're going to hold it. The third option is to exit at 7 years. Sometimes there is a refinance in the middle if we meet certain NOI and we feel like refinancing we can pull some of the equity, return the capital invested, even if it's partially returned, and then continue to cash flow. So that's what we do the underwriting. We do different scenarios, and then we present them the one that makes more sense. So some of the underwritings, or some of the deals that we are invested, or we have already in our portfolio right now, we are at second, or we're in a 1.5 year of acquisition, and we are already performing at year 2.5. So we are already ahead of projection. So depending on where you are, we can consider right now, we can consider refinancing, getting a better interest rate, or and then, cash flow it for the longer time, or we could sell and maybe offer, instead of doubling the money, we can say, okay, well, we didn't double your money in 3 to 5 years, but maybe we can, 1.6, 1.5 your money and in less than 2 years. Yeah. So we have some options, and that's what we continuously underwrite our deals. So we usually do quarterly underwriting just to see where our NOI is heading. And then we have the projection. And when we underwrite, we present to the investors, this is projection on year 1, 2, 3, 4, 5. And then based on that, you can, measure your NOI and say, okay, we are close to year so-and-so. And then based on that, we're continuously also working with the lenders and the brokers to see, hey, what's the appetite for this kind of property? If somebody is willing to buy it and the property is steady and performing, maybe we can put it in the market and sell. So our job as general partners is not only to present you with the model of this is the 3 to 5 year holding, but also on an ongoing basis, we're going to be evaluating what's best for the business. Remember, this is the business. Once that we reach a certain NOI, we meet the projections or close to the projections, we present that as an option to the partners, and together we decide, is this something that we want to exit, or is this something that we want to hold because it's a young property, it's cash flow, and now we already implemented all the capex. Really, there's nothing else to do. Can we just sit on it, and even if it's a low cash flow, we can keep it? That could be our steady property in our portfolio. So those are the things that we are ongoingly analyzing and presenting to the partners.
And you mentioned the refi. I've heard this a few different times. That's kind of the sweet spot when you have the ability to refi that, right? You pull a bunch of cash off the table, you return it to the investors, and then the cash flow ideally looks still pretty good. So refi is a sweet spot, isn't it?
Yeah, it is. It's good. Now the cash flow, if you think about it, if you're thinking of a house, if I refinance my house, I'm gonna ideally pull the equity and then get a loan that is higher right. Loan to value. So the monthly mortgage payment is going to go up. So the cash flow might suffer for a little bit. It will decrease, but at least you have your capital back that you can put that to work somewhere else.
It's another spot.
Absolutely.
And you view all of these categories, whether it's a storage facility or mobile home park or whatever, generally the business concept behind it's the same for you. It's the NOI, it's the asset, how it performs. Conceptually, somebody like myself that's not really educated in the space, I could actually think of it all the same. It's just an asset class, and it performs one way or another.
Absolutely, yeah. So that one differentiation that I'll make is when we are speaking or we're talking about apartments. Most people, you're going to retain your residents because most people want the newest everything, so keeping your what I would say, focusing more on retention of the residents. So maybe you don't need to do a full turn on your unit, but maybe you can offer something to the current resident to maybe give them a ceiling fan or change the cabinetry, or maybe add something like maybe better lights, and that will probably buy you into another year of retention. And when it comes to mobile home parks, people that moves in that type of spaces, it's actually quite expensive to move a whole home. It's probably sometimes even the same amount for whatever they bought it. So for them to move is just very expensive and not feasible. So what we want to do for that community is do amenities, make sure that there's the community is safe, that it's always looking clean, so that we can keep them that kind of ambience in the community. For the mobile home, for the self-storages, it really is just making sure that you are competitive when it comes to the rates, because people in the storage is probably more likely to move their stuff with less amount of time, and they can move it if they can find another special somewhere else. So we continuously looking at how are we comparing to other spaces and other self-storages nearby. and maybe enticing them with that we give you a discount, or we go up in the rent, but we give you, we want you to stay for this amount of time. So there's an ongoing study of the market and staying comparable.
All right, so here's a question that would keep me up at night if I were a GP. Let's say I were a GP. Operators, and let's use the storage facility as one. How hard is it to retain operators? I mean, you're going all over the maybe all over the world, I don't know, but certainly within the US here. Is that is that a big obstacle? Operators for all of these facilities?
Well, operators, we are operators, and operators are very invested in the deal. So we either sign on the loan, or we have investors that trusted us with their time and their money. So yeah, we are very in tune. We are not working for the business. We are actually the business. So yeah. So once that you commit yourself to being the operator for this specific asset or this deal, it is in your best benefit to stay in tune and make sure that you're showing up to the meetings and everything. Now we do hire asset management or community managers, like for the mobile home parks, yeah, or ground managers for the self-storage, and maybe that's what you're referring to. Those are 1099.
That is, yeah. Okay. I understand you guys are there, but you're the point person. Like if Tom Swincer decides that he no longer wants to run the day-to-day operations, face-to-face operations of that storage facility, you're on the back end backfilling that right away.
We normally will be interviewing somebody else, but in the meantime, we'll be gapping. Yeah, we'll be taking over, but we are dealing with, so this is the difference when we are working. Let's suppose that we have a property manager for or 35 apartment complex, or when we're doing our own. That property manager is probably we're going to be at the bottom of the list and their priorities, because we have only 35 doors, right? When we are talking about property manager for our bigger complexes, they also get bonuses. So they get bonus on the rent collected, on the lease and the leased units. So they're very in tune with wanting to keep the occupancy high. We give them that kind of benefit so that they are pretty much buy into making sure that the property is performing well, because they get compensated based on the NOI, or the revenue. So, and then we can afford better property managers, because, if we're talking about collecting millions of dollars in rents, not compared to, our portfolio.
So they're exciting to be a part of. The bigger the projects, the more exciting they are. So it's less likely that you're going to get somebody that walks out the door on 35. But to be clear, if it's a 35 unit building and the property manager decides that they want to move out of the country and they give you a day notice, that falls into your lap specifically.
Absolutely.
And that becomes your fire drill.
Yeah, absolutely. Okay. And that's why one of our criteria is 125 units and above. Last year we bought a 24 units, mostly because we're mentors and friends to this couple that we wanted to buy something with them. And it's just taking so much time out of the day that it's just, we definitely want to talk, we want to be handling properties that we can afford, that the property can afford, professional manager, professional vendors, that we are their top priority, that we are compensating them well, because we can cash flow and have a better NOI.
Got it. I see you're 10X certified above your right shoulder there. What is 10X certified?
So yeah, we are business coaches for Grant Cardone team. We are part of that Grant Cardone team. Yeah. Okay. So that's the certification that you have to obtain, but it's business coaching.
Got it. Okay. I've asked a ton of questions. My voice is getting hoarse.
I love it.
What else do you want to convey here in the last few minutes?
So I will say, if you're looking to be hands-off, take advantage of the big tax breaks that the syndication model gives you, and pretty much grow your wealth. And I would say free of tax, because that's what we have achieved. We have been zero taxes for 3 years, federal taxes. We're based in Texas, so we don't have state taxes now. That just to clarify that the businesses that we have still pay taxes and employ hundreds of team members. But personally, that's how we've been able to shelter and increase our net worth. So if this is something that interests you, definitely seek out to either us or there's tons of syndicator groups that we can definitely, give you more information about it. But that is definitely where we found our sweet spot instead of doing it ourselves, to grow together. And it is possible, especially if you want to be like us. We wanted to preserve our cash flow, continue to scale and decrease our liability, and overall just keep reinvesting our profits. And that's what we've been able to do.
Got it. Well, you just keep rolling it. Good for you. Congratulations. Sounds like you're having great success. Well, I appreciate the time, and I feel like I came away with some very good foundational knowledge to know. Oh, the only question I forgot, what is your minimum investment amount that you have for the investors you work with? Let's say as a passive investor.
Yeah. So the minimum, most of the deals is 50,000. And also we take self-directed accounts, self-directed IRAs and 401k. So and even if you have some 401k that you're no longer working for that company, you can roll it into a self-directed. And self-directed accounts, it just means that they allowed you to invest in alternative investments. One of them being syndication or flipping money. Or there's other alternatives that they allowed you to invest. So definitely, if you're sitting on some retirement accounts that you don't know what to do with them, you can definitely have some fun and learn the business and the market.
Interesting. I love it. Well, thank you for your time. And I'm going to send you a friend request right after we get off. I think I got a lot more to learn from you. So I appreciate it. And have a great afternoon. Thanks for being on.
Thank you, guys. Thank you, Jason. Thank you, Jake.